Hello and welcome to our Yardi Matrix self-storage update on September 17th, 2020. My name is Megan Furr, your producer for today's program. We are joined today by our hosts Jeff Adler and Chris Nebenthal. During today's broadcast, we will comment on the economy and its impact on investing, managing, and developing properties across the country. Our program will run about an hour, and we hope you can stay with us for the entire broadcast. We want this to be an interactive conversation, so please feel free to submit questions in the comment section on your screen, and we will try to respond to your messages while covering relevant topics. If we don't get to you, please contact us afterward for a more detailed answer. A recording of this broadcast and accompanying slides will be available after the program. Please note that what we discuss today may or may not be relevant to your situation. Please read the disclaimer carefully and consult your tax and investment advisors before making any decision. Now, I am pleased to welcome Chris Nebenthal, Editorial Director, and Jeff Adler, Vice President of Yardi Matrix, to our program today.
Thank you, Megan, and thank you, Chris, and thanks, everybody. This is Jeff Adler. We've got a lot to cover today, and so we want to kind of get into it. We'll be covering five, basic areas. Overall view, very quickly, of the economy, what's going on with the storage REITs, an update, as we generally do on major markets, but then also a bit of a deeper dive into the next tier of markets that we don't normally cover, and then some cross-reference versus multifamily. So in terms of an overall view, we like to give you the answer before we kind of dive into things. It's not a rocket science. We all know that the economy plunged into a deep recession, but the recovery is beginning. Now, it's really a question of the shape of that recovery and how that kind of goes forward. The initial purpose of the lockdown was to avoid overwhelming the healthcare system. And now, as we come off of that, that's the issue. Has it been successfully done? But now we have to find a new normal. Consumer confidence, well, it's low, but I think it's actually confidence versus spending are sort of disconnected, and you can definitely see behaviors shifting in consumer back to goods from services. And the goods and producing industries and technology industries actually are doing quite well. Face-to-face services have really gotten crushed. Restaurants, hotels, experience-driven industries are going to struggle, and I think we're looking at this honestly through mid-year next year. Even as the economy recovers, to really recover the employment is going to take some time. We've had political disruptions. We're not done yet. We've had social disruptions. We're not done yet. That will actually probably cover all the way through the end of the year in whatever aftermath. Whoever wins or loses, people are going to be unhappy. The third quarter GDP numbers will look really good, but remember, 30% off of a lower bottom is not back to kind of full recovery. As it relates to storage now, the street rates fell dramatically right around March and April and May, and they've started to stabilize in June and July and began improving in August. So that's kind of really quite positive. If I go back to sort of occupancy levels, there was a period of decline in April, but really since then, April occupancies have not gone down. And even though there's been some moratoriums, if you flesh that out, it's still the sector's actually doing quite well. Construction did slow down heavily in April and May. June and July deliveries did accelerate, but August kind of dropped again. The overall pipeline, hasn't changed, but we do see that fewer projects are breaking ground. Abandonments are beginning to increase. We'll talk about a little bit more of that. What we see right now is deliveries we think will fall roughly 10% in 2020, 40% in some of the out years. But we do that really kind of sets a new positive cycle because fundamentals are holding up reasonably well. So that's the good news. And what that means in my mind is that development will sort of come back, perhaps even more strongly and more quickly than in the GFC. And so what that kind of tells me is, on a summary basis, that the general slog in self-storage continues. I think there's some emerging upsides to it, but we should expect, continuing kind of slog conditions where you can get 2 to 3% ECRIs, so that the overall profitability of the sector hangs in, even as kind of lease ups, take longer to come to fruition, which really means kind of a continuation of the trend we saw before. So let's see if I've got here. There we go. So to talk about sort of the overall economy. Not a surprise. The COVID-induced recession and lockdown really kind of hammered the second quarter. So we're really kind of the issue is really looking forward. We share the view. Some folks from Evercore ISI, Ed Hyman's a great economist that I follow very, very closely. We're going to have a fairly strong third quarter. He's anywhere from 30 to 35%. But in terms of getting back to where we were, you're really looking at kind of first quarter 2022. But that means is that we will have a kind of growth back in the economy, and depending on who you talk to, that's either a V or a U-shaped recovery. All the pieces are in place. The liquidity support, both the fiscal support and the monetary support means that we're going to be back there. Now, employment will lag this GDP growth. So in terms of employment growth, we're probably talking about all of 22 before we kind of get back to the employment level that we were at before. So it'll take some time on the employment side. From a financial market perspective, what the financial markets are kind of signaling to us from the S&P is that, as you look forward, earnings look to be in decent shape. They are skewed by sector. There's a lot of variation. The 10-year is down a lot, 60, 70 basis points, and based everything that we're hearing from Powell and looking at the sort of labor force participation rate plus inflation versus interest rates, and when there are statements, we're going to have low rates for a long period of time for the economy and the labor markets primarily to sort of recover. You see that in the positive sloped yield curve, which is sort of flat for a long time, but it is positively sloped at the long end, and bond yields around the world are low. So that kind of sets the stage when we turn to valuations of properties. What the fact of the matter is that the reduction in debt rates have basically offset the sort of disruption in NOI, and so values have held up pretty well. And you'll see that actually in the performance of the self-storage REITs relative to other REITs in the public markets. Now, in unemployment rates or jobless claims, this is initial jobless claims are still elevated. They're under 1 million, so they've come down from horrific to merely horrible. So we've got a long way to go. And if you kind of look here this is a better measure because it's continuing weekly jobless claims. While it is down, it's still at an unbelievably high level, and we've got a long way to mend. This is sort of from an employment standpoint, unemployment rate, depending on how you're measuring the headline rates, kind of 8.4, the U6, which is a kind of a pretty good measure, is at 14.2. You compare that to the GFC, we're pretty darn high, right? So it's up a little bit below the sort of peak of the GFCs, but it's a long way to sort of full employment. It happened fast, no surprise, compared to other sort of debt-induced or traditional economically induced recessions. So that's why we also think the recovery will come back faster as well. This is just to, again, put this in kind of context of the speed of the loss and the depth of the loss. Pretty bad. There's still a lot of unemployed persons for job opening. Remember, we were under 1 before this whole thing kind of went down. We're kind of back, if you look at that, more like what conditions in 12 and 13, right, in terms of unemployed persons for job openings. But it is much more concentrated in certain industries. The flip side of that is the federal debt to GDP. This is a concern. Federal debt to GDP looks like it'll go over 100%. This is kind of wartime numbers last seen in World War II. There's got to be some response to this. It either manifests itself in inflation or higher taxes or some combination of both. And in the 40s and 50s, it was the combination of both that got the debt back down. And I think we'll probably see some combination of that as well in the future. When you look at inflation and kind of oil prices, if we see inflation, it's going to be on the goods side, because we've always had a certain amount of inflation on the services side, but it was offset by goods deflation. So the only thing we're going to see is we'd have to see goods inflation, and it's hard to see where that's going to happen. So oil prices aren't, and if you look at the kind of break-even rate, this is the 10-year break-even rate on tips. You're still well below 2, in the 1.5% range. And again, as the Fed has said that they want to see an average of 2%. And since it's been below 2% for so long, we could actually see we wouldn't really have interest rate action until inflation was above 2%, 2-ish%. So, low rates, low inflation for some extended period of time. Now, from a consumer standpoint, there has been a shift towards goods consumption as opposed to experiences. And over the last 10 to 20 years, the shift had been away from goods towards services and experiences. This has kind of shifted it back. I don't really think this is a long-term trend. It's probably more of a 2 to 3 year trend before it reverts, but that will be a bit of a tailwind for storage. And then when we kind of get to, shifting to value and essentials, let's say the income that was preserved, right, for people who are in tech work or people who could work from home, who weren't face-to-face businesses, their income has been redirected. It wasn't destroyed, it was redirected, and on things around which they could spend money on. And you've also seen a shift to digital on the channel, which is basically continue to accelerate a trend out of retail locations, which is continuing to kind of happen. So as that emerges, we really see, this is something I've talked about for a while and continue to talk about. There's 6 big trends really where some of these things are, to a certain extent, accelerating or sort of reversing. Okay, so e-commerce is really an acceleration of trend. Virtualization, the ability to work from anywhere, has been sort of accelerated. Local political risk and higher taxes, in my mind, has been a trend that we've talked about before, that was seen through rent control legislation and has been heightened, and also quality of life issues and law and order issues. Those problems were there before in certain urban centers, and this period, the last 6 months, have accelerated those trends. Now, some areas in which we were beginning to see a reversal of trends, and this again has been accelerating that reversal. One big change I would say is, we had seen a continuing movement of experiences over things. The whole sharing economy was about experiences over things, being able to sort of have fractional ownership of something or a use of it versus ownership of it. That's been reversed or reversing. But densification has been reversed. We expected to see some of this kind of unwind as the millennials aged, had kids, and moved out to sort of urbanized suburbs. We've seen a sort of acceleration of that de-densification trend. It's been compressed. Something that might take 5 years has taken 6 months. So that's kind of moved. We also have begun to see deglobalization, particularly on the trade side and movement of people and goods. That was under pressure before, and that globalization trend has been sort of the reversal of that has been accelerated. So that's kind of, even when I say it's reversing, it's really sort of the acceleration of a reversal that had kind of started already. And I would say the one discontinuity in all of this has been the movement of, I'll call it the revenge of the things, of people spending on hard goods and movement of that hard goods. But I think that will slowly unwind as we move into the end of 2021 and 2022. So setting the stage
quick question
there.
Here.
Yes. Mm-hmm.
Do you see a bigger problem with rising real estate taxes as it affects self-storage facilities?
I would place that under the locations where you had political risk in the first place, and political risk meaning difficulties in sort of local governance, high spending, high regulation, the erosion of public safety. You've seen sort of an acceleration of that, and with that comes increased tax burdens. So I think you'll see places like California, like New York, like New Jersey, Connecticut, Illinois, that were under a significant, were risky already will get more risky and taxes will rise faster. I think you will see, even in places that are generally considered relatively good governance, because of the dramatic shortfall in local budgets and the holes in school districts that has occurred, I do expect to see an increase in local property taxes, even in places that have been generally well governed, just because the holes in the budgets of the municipalities and school districts are quite real. And there's going to have to get patched over some way. It's probably not going to come through property taxes among homeowners, but I do think it'll come among commercial real estate owners, of which self-storage will be affected. Now, it affects self-storage more because property taxes are a larger component of the total cost structure of self-storage facilities. But I do think it will be something that will have to be contended with, right? Even as revenues from self-storage, at least from a street rate perspective, are going to come under pressure. Great question, Megan. Thank you. When we look at the REITs and what they're basically kind of saying, right, from the calls we've recently had, they're anticipating delays for prospective and planned projects, but just as we saw in other areas, the ones that are under construction, they're going to get done. I think a lot of folks are hoping that the other guy will slow down his development or her development, not affect theirs. But what I do see is, while there may be some reprieve for a certain period of time over the next 2 years, I do think the building wave will continue. Most of the REITs are expecting to see stable street rates, and they are beginning to increase ECRIs. They're beginning to move forward with auctions and evictions. I was talking to a couple of friends in New York where they were paying people to get the heck out just because they actually had paying people behind them and a shortage of storage, particularly of the 5x5s and the lockers. But so I think there's confidence in the sector, and I think if you look at the public markets, they are valuing REITs above net asset values, one of the few asset classes that are, and the erosion in stock prices has been fairly low. And so I would say among asset classes that have proved resilient in the downturn, you'd have to place self-storage up there with data centers, industrial, and manufactured housing for some of the best performing asset classes in a downturn. And so that will unquestionably attract institutional capital back into the sector. There's a lot of institutional capital already, but I actually see more institutional capital coming in that was not able to get put to work and will now do so. So with that, I'm going to turn it over to Chris to really take a deep dive into the actual self-storage fundamentals. Thanks a lot.
Thanks, Jeff. And as you mentioned, a number of the trends that we're seeing from the REITs, we're also going to see that in our own data that we'll present here. But as we get started, we'll talk first about demand. Certainly population growth, domestic migration are one of the key drivers of demand that we're continuously following for the self-storage industry. But we've noticed, especially in the last 6 months, there seem to be some new niches. And in talking with a lot of developers and talking with a lot of owners, we've seen that one of the niches that has emerged are small businesses, restaurants and retail shops that have to change their floor plans due to social distancing and a number of the new normal requirements. Same thing with college students that had to kind of pack up practically overnight and leave their campuses back in the spring. A lot of those contributed to demand for self-storage. And as Jeff was talking about as well, kind of the return to a goods-based consumption system. And a lot of those goods have been rather expensive goods, RVs, boats. And we see more and more of an interest in RV and boat storage. Now, the RV and boat storage discussion is a bit of an interesting one. Most of the time you'll see opportunities for RV and boat storage in more of the suburban areas. Perhaps the older facilities, the Generation 1 facilities with larger footprints. Now, that might not work for all operators, but it's an interesting niche to look at if you do have a large footprint, land to expand on. RV and boat storage might be an interesting might be an interesting opportunity. But again, those are more of kind of the niche areas of demand that we've been hearing about from many of you in the industry. But focusing again back on kind of the key drivers, population growth. Where is it growing and where has it been growing? It's in these secondary markets, the Austins, the Phoenixes, Raleigh, Durham, all across kind of the smile of the United States, the southern portion and into the Mountain West region. You're really seeing the strongest and accelerating population growth. Again, some of the cities that Jeff mentioned with more regulation and more risk associated with them, Chicago, New York, LA. And looking at domestic migration as well, you're seeing the same trend. It's these secondary markets where a lot of the domestic migrants are coming in, domestic out-migration in some of those gateway cities. And in years past, the gateway cities have really been kind of bolstered or backstopped by large international immigration populations. And certainly with COVID, as well as recent political influence, there hasn't been as much immigration. So where we see the domestic out-migration, it's really kind of a double-edged sword in these markets because they're not getting backstopped by a lot of the international immigration. So while we don't have specific data on domestic migration, the chart that we just saw was as of July of 2019, we do see a lot of anecdotes that says those migration patterns are continuing. And they're continuing in two ways. One is they're leaving the urban cores of big markets, downtown Manhattan, downtown Los Angeles, San Francisco Peninsula, and they're moving to the suburbs, looking for more space, perhaps looking for a yard, larger living area, but they're also moving to secondary markets, secondary tech hubs, specifically the Denvers, the Austins, Raleigh, Durham. You're seeing a lot of the migration there. So I don't think the big markets are dead. I don't think they'll be struggling forever. But what we do see, especially with a lot of these anecdotes, is that people are leaving the Northeast, especially the New York Metro, as well as parts of California, parts of the Midwest as well. Looking at search data, so storage actually is doing quite well. When we look at our internal Rent Cafe and Storage Cafe search data, it's been up significantly since the first week of the year. We did see a little bit of a drop-off right when COVID started, week 14. That's kind of the middle of March, end of March, getting into April. But again, a pretty strong rebound over the past 6 months, telling us that the demand for storage has been there and has been stronger than some of the other asset classes in commercial real estate. The Google search trend for storage has been pretty flat. Again, a little bit volatile into the spring and early summer, but also recovering over the past couple of weeks. So now we'll kind of get into our main fundamental slide. And for many of you, you've seen this slide before, looking at penetration rates across the bottom, the net square feet per person, as well as what's in the new supply pipeline on the vertical axis. So this is the data looking at August of 2019. And you kind of see a number of the markets spread out. Those red markets in the middle there indicate street rates are falling by 5% or more on a year-over-year basis. Those are really the markets that are getting hit the hardest as of last year. The yellow markets are doing okay. Street rates are down modestly, but not terribly. And then those green markets are where we're seeing growth. What I want to point out here is really the dispersion and kind of the difference in each of the markets. As we move on to January, you see those markets really clump together. More of the stock have been delivered. More of those markets turn green, showing growth. Far fewer red markets. Some yellow markets still remain, meaning that there's modest rent declines or modest street rate declines. But overall, still a pretty decent picture as we moved into 2020. Now, interestingly enough, the story looks very similar today. For any of you who've seen the monthly reports, you know that through June, through July, we were seeing tons and tons of red markets, tons and tons of yellow markets. And as Jeff mentioned at the top, operators and owners really just cut street rates overnight when COVID hit. Uncertainty about demand, uncertainty about the future of the industry. But given that storage has really been resilient, we've seen those street rates pop back to either flat or positive in a number of these markets. Even in some high supply markets like Las Vegas and Sacramento, even in some markets that are highly penetrated, like Raleigh-Durham. So again, this just speaks to really the resiliency, and I would say the counter-cyclical nature that the storage industry has displayed, not only now, but we saw it again back after the great financial crisis and in the 2008 recession. So we'll take a bit of a deep dive into the street rates now. This is looking at street rates on a year-over-year basis. So again, you see some dispersion, Minneapolis, Nashville, Charleston, really still seeing some significant negative year-over-year street rates for the non-climates. But the Inland Empire, Chicago, San Diego, actually doing fairly well on a year-over-year basis. The newer stock, the climate controlled, as to be expected, those numbers are struggling a little bit more, given that we are still battling through the supply wave that we've been seeing the past 5 years. But all in all, I think flat street rates in Miami and Phoenix, that's pretty good. Modest declines in some of these other secondary markets is quite good. Again, especially compared to what we saw 3-4 months ago, right at the outset of COVID. But now I want to focus on the month over month, and again, the quickly changing rents, and this information seems to indicate that we hit a bottom somewhere around June or July, and that we've actually seen rents start to accelerate. So the July to August numbers, really, really strong for the non-climates. Almost 4% in Miami, Chicago, DC, Raleigh-Durham, really good month-over-month performance on the non-climates. And even some of the worst performing markets of Pittsburgh, Nashville, Dallas, those numbers are still flat. So further indication that, again, it seems like we've reached the bottom. We're starting to recover on the street rate side. Similar story on the climate controlled, a little bit more dispersion. San Jose actually is quite surprising to see such a strong pickup. San Jose's got a lot of new supply coming on. I don't know if that performance will stick around for a while, but again, really reassuring that the rates have kind of reached a bottom and they're now starting to come up. So now we'll dive into our new supply forecast. And one of the things we did about midway through last year is we revamped our new supply methodology. So the new supply forecast started to include property expansions. They extended the forecast out 5 years. They were looking at precise net rentable square footage at the property level rather than just a project-based forecast. And so what we're doing now is not only expanding the forecast, but also simulating new projects coming in. Previously, we were only looking at projects that we were aware of in the pipeline. But what we started to do is simulate those further out years. And as you mentioned, we do expect to see a significant decline in those out years. So when COVID hit, we had to make a couple of assumptions to our forecast. And what we expected and what we continue to expect is that the speed at which projects are moving through the pipeline is going to slow down. Now, the projects that are in plan moving to under construction, we've reduced the speed by about 40%. And similar thing with prospective to planned, we've reduced the speed that those projects move through by about 50%. We didn't change the speed of the under construction to completed status because what we saw was that if there was dirt moving, if there were projects coming out of the ground, those projects were going to finish. Now, in a number of markets, there were construction moratoriums like Boston, parts of the Northeast. Other markets, just due to social distancing requirements, projects were delayed. But again, we assume and we continue to see that those projects that were already under construction are going to complete. Another key change that we made to our assumptions was to increase the abandonment count. And we'll look at the abandonment data in just a minute. But we increased the prospective to abandoned projects by about 50% and the plan to abandon by 25%. And what we saw here is that a lot of the experienced developers, they might keep their plans going. They might have the capital and the experience to see through the recession. But some of the newer players to the market or some of the smaller players to the market, they're likely to be pulling those projects out of the pipeline. So again, when we look at abandonments, a lot of them are going to come out of perspective. Some may come out of planned. we don't really expect any of the under construction properties to become abandoned. So what have we seen as a result of those assumptions? Well, again, we expect deliveries to drop by about 10% this year. That's mostly due to the immediate slowdown and the immediate delays we saw in the end of March, April, and into May. But construction activity has returned to pre-COVID levels, so we expect those completions to kind of finish at a normal pre-COVID level for the rest of the year. It's really in those out years, the 2022, 2023, 2024, that we expect the bulk of the removal of projects to impact new supply. And we expect new supply to fall by about 40% at this point. As Jeff mentioned, if storage continues to be countercyclical and if it does outperform some of the other asset classes, we may see a quicker rush back into development. Right now, we don't expect that. But as we move through into next year and into 2022, if fundamentals have drastically improved and are continuing to remain strong in storage, we may see the development return faster than we expect to see today. Abandoned projects have increased. Yeah, Megan, go ahead.
Sorry to interrupt. Quick question. Just to confirm, are retail conversions included in the supply forecast?
They are, yes.
Great, thank you.
Sure. So in terms of abandoned projects, we have seen those numbers jump, especially in the past couple months. And again, developments that are under construction, those are going to be built. Maybe they're delayed 3 to 6 months, but we're confident that those projects that are already coming out of the ground will come to completion. So looking graphically at what our forecasts say now versus what they had said in a pre-COVID environment, the pre-COVID environment is that hashed line that you see, the light blue and the dark blue hashed lines, where we were seeing more of a modest slowdown in development. Development and completion peaked in 2018. We still expect that to be the peak, certainly of the last cycle. But now we're seeing a much steeper decline, similar to 2007, 2008, 2009, where we expect those deliveries to fall off at a much faster pace. That's really shown in that 40% reduction in those outer years. Looking specifically at the numbers, we expect to see about 750 projects finish this year, and that's going to be about 54 million net rentable square feet, just under 4% of existing stock. Next year, looking at just over 600, and you see those numbers tapering down into 2025. Same thing with the percentage of stock getting closer to 3 and then down towards 1% of existing stock out in 2025. Again, those numbers could come back, and we'll continuously forecast on a quarterly basis as we do. If fundamentals continue to be strong, if we see more development activity return on sooner rather than later, those numbers could increase down the road. But at this point, we really see that tapering off quite significantly. Looking at the major metros, just under 500 stores delivered, and a little bit more as a percentage of stock compared to the national level, just under 4.5% of stock, equal to about 37 million net rentable square feet this year. So looking at both construction starts and completions, starts have really started to fall off. Starts had grown into April and May. I know we were into the depths of COVID at that point, but I expect a lot of those starts were people that and developers that had gotten their permits, their crews were ready, the sites were ready to go, and they continued to push forward. But what you see in June, July, and August, and I expect this to continue, are fewer and fewer starts. Again, I think those planned and prospective projects will move slower through the pipeline to reach the construction phase. More of those projects will get abandoned, and we'll see fewer and fewer starts through the rest of this year and into 2021. Looking at the right at completion, the blue lines, the blue bars, I should say, are 2020. 2019 are the gray bars. And you see 2019 was pretty steady, anywhere in the 60 to 70 store completions per month. We were on that pace in January, falling off slightly in February. March and April is where you see the big hit. But then those deliveries have really come back. June and July August is a little bit low. Oftentimes we've got a lag as our data comes in. So I expect those August numbers actually to come up just in line with June, July, and in line with what we saw last year. So the construction activity is back. Again, that 10% decline is really a result of the slowdown in completions in March, April, and May. Now let's talk about abandonments. So as I mentioned, abandonments are up specifically in July and August. That's the light blue line over on the right side. And I would expect to see those abandoned properties continue to rise. Now, we're well above where we were last year as more projects are pulled out of the pipeline, as more developers decide to kind of pull back given how much supply we've already added over the past 5 years. I expect that to continue. And again, a lot of those projects will be coming out of the prospective phase, coming out of the planning phases that we're looking at right now. So where are the abandonments? Well, not unsurprising, a lot of the abandonments are coming from markets that either have significant supply pipelines or are having a lot of lease-up pressures due to recently added supply. Markets that come to mind are Boston, Portland, Denver, Phoenix. All of these markets have been adding lots and lots of supply of late or have robust pipelines. So that's where you're seeing a lot of the storage abandonments thus far. We'll continue to track this through the rest of the year and into next year. And it'll be very interesting to see where exactly these abandonments are taking place. But I expect a lot of them to take place in markets that have significant supply pipelines and are facing a lot of lease-up pressures right now. Despite the abandonments, there's still a lot of expansion activity. You can see that here. There's expansion activity pretty much across the country. We've said in the past that expansions are really an opportunity where new builds can be more challenging. So think of places with higher regulations to build, more strict zoning codes. If you've got a property already zoned, it's a lot easier to expand than it is to start a new build. So we do expect the expansion activity to remain fairly robust. Again, the brown dots and the blue dots are the planned in perspective. We may see some fallout, some abandonments in that area, but the expansion activity remains pretty strong in most parts of the country. And again, as we've seen, it's not just a 20,000 or 30,000 foot expansion. A lot of these expansions are 80,000, 100,000, 150,000 net rentable square feet, which are the equivalent of almost a new store. As Megan questioned, we are still seeing a fair amount of conversion activity. The 2020 numbers are as of September, so the 2020 conversions might come in a little bit light. But what we've seen certainly leading up to the recession and through the recession is that the opportunity for retail conversions remains quite high. More and more big box locations are filing for bankruptcy or closing their stores. Oftentimes these are in highly trafficked locations. So the opportunity remains pretty ample for conversion activity, especially in the retail area. And finally, this is just our overall new supply pipeline. So we see New York, Las Vegas, Sacramento, Portland with some of the most robust under construction and planned pipelines. I would expect to see a lot of abandonments start to come out of those markets with really high pipelines. This looks at both under construction and planned. So some of these projects might fall, especially from the planned phase. Some of the recent legislation and moratoriums we've seen have been impacting the self-storage industry, both before COVID and as a result. The big one is the ICAP program in New York. That was pushed up about a year and a half in order to take advantage of the benefits with that. So for developers that weren't able to begin breaking ground and begin constructing before that deadline, we may see more abandonment activity in the New York area. Again, that's the market with the highest new supply pipeline right now. So it wouldn't surprise me to see more abandonment coming out of New York. Some of the recent legislation and moratoriums we've seen have been impacting the self-storage industry, both before COVID and as a result. The big one is the ICAP program in New York. That was pushed up about a year and a half in order to take advantage of the benefits with that. So for developers that weren't able to begin breaking ground and begin constructing before that deadline, we may see more abandonment activity in the New York area. Again, that's the market with the highest new supply pipeline right now. So it wouldn't surprise me to see more abandonment coming out of New York. With that, I will turn it back over to Jeff. Jeff is going to talk more on the next tier markets where we see opportunity in some of the smaller markets.
Oh, thank you, Chris. So just kind of looking at this, I'm going to back up a second there. The migration pattern isn't quite as strong when we look at population movements because we're looking at sort of smaller markets, and really the action is from larger markets into smaller markets as opposed to a reallocation between the smaller markets. But such a negative migration as there are tends to, kind of be in the sort of, I'll call it Rust Belt-ish set of cities, more toward these smaller southern, western kind of tech hub or emerging tech hub locations. And then when we kind of go here is, again, you're just going to mirror the same analysis you did in the larger markets where, hey, last summer, you see a lot of green, a lot of growth in these smaller markets, even where there was a lot of penetration in terms of square feet per person. Look at Boise and Reno, right? Yet rents were growing because migration was continuing to add population into these areas. Now, again, we saw acceleration of growth into early 2020 in the next tier markets. That's a pretty positive set of colors compared to the larger markets. Then if you look at now where we stand now, that's pretty darn good, right? So you're looking at August 2020 growth on a year-over-year basis. Looks to me like the supply pipeline have kind of come in some, but even in places where it is fairly robust, Boise and Reno, street rents are still growing. So this is an area where we kind of see that the storage market has kind of is moving towards, and I think will continue to sort of build out some of these smaller markets. Going to the next, on the rent side, you can kind of say, look, this is a year-over-year growth. This is non-climate controlled older stock, but there's some pretty strong rent growth in some of these smaller markets. Not universal, obviously. You've got some negative ones, but those tend to be the places that have tended to lose some population. So if you look where populations are growing, rents have been pretty good on the non-climate side, and then we always take a look at the climate side, which is a little more sensitive to new supply. But again, you're seeing some pretty decent growth rate even at new supply areas for places like Jacksonville, Omaha, Boise, and Grand Rapids, which also are places that I think have been benefited. If you read through the migration of tech talent into smaller markets, some of these markets have been beneficiaries. This is the sort of movement off the bottom that Chris alluded to, and you can kind of see some markets, a wide number of markets actually doing quite well, at least not badly, right? And we haven't seen rent deterioration. That's non-climate, and we go over into the climate control side. Again, you're seeing markets movement nicely on a month-to-month basis, showing kind of movement off the bottom. And in this case, continued positive rent growth. Very encouraging for some of these smaller markets. When we look at the new supply, more muted, right? So if the analogy, I think, for the whole country would be on the 5 side, the larger markets 5.4 in 2020. Here you're seeing a 2.5% growth and a more modest level of growth as we forecast it, assuming there isn't an additional rush into these markets. So these markets they are smaller. We expect to see a bit more volatile in terms of, because of their small size and new supply adding each new project is a greater percent of total supply. But this is a pretty positive story. There's less expansion activity in the next tier markets because there's less stock of properties to expand upon. But it is still activity that's going on. And you can see here, look at that conversion, right? So conversions are a higher percentage of the total amount of activity. Makes a lot of sense. And also in these smaller markets, you're seeing more of the JCPenney's and Sears as they retreat from these cities and create opportunities for conversions, and I suspect that will also continue. There are some, heavy new supply pipelines, but these markets have shown a proclivity to be able to absorb those, particularly the Boise and the Renos. High penetration, high supply, yet being able to absorb it really off of the fact that fewer people migrating in right, are able to absorb that supply. And so I do think there's obviously more caution and care when one enters a smaller metropolitan area. But as we've always said, storage is kind of a micro market kind of business. And so again, it's all about the 3-mile or 10-minute drive radius around a location and the populations to support it. And so it's highly encouraging that there's a world outside of the top 30 markets. And one thing that I'll cover, because I cover the multifamily sector, quite a bit, it's just this relationship that we have data on the multifamily sector, and we look at multifamily versus storage rates. It's really I got to tell you, a very interesting story that's kind of emerged that really surprised both Chris and I. I mean, we actually shouldn't have been surprised, but we kind of were. Look at Manhattan, right, where multifamily rents kind of cratered since COVID. But storage street rents actually went up a lot. And again, they're actually quite symbiotic. They had a lot of people who moved out. Not all of them were moving out permanently. Most of them were not. They needed to store their things. You see that same thing in Los Angeles, to a lesser degree in San Francisco. So we definitely see some movements, right? And in Atlanta, let's go to some of the bottom markets. Atlanta and Boston have done quite well on a multifamily side, and their street rents have been under pressure from the initial COVID shock and haven't fully recovered. So they're really, these two sectors are really sort of paired in an inverse relationship. It certainly seems to be the case. Go to the next slide. So in the larger markets, there does seem to be a continuing spread between multifamily price rents per square foot and an older storage price per square foot, which would indicate, all other things being equal, that there is continued opportunity to raise rents, right, in many of these major markets. But it is subject to the supply, situation in storage specifically, whether that potential can be realized. We also see some of that same. There's fewer opportunities of that in the next tier markets, mostly driven by the fact that rents for apartment rents, in these secondary markets or tertiary markets have not really expanded to the same degree they have in the larger cities. So, but it's something we watch kind of on a regular basis. And so, kind of wrapping the whole thing up, which is really just a return to the two slides we had before, right? We had a deep recession. We're in the middle of recovery. That recovery is likely to be choppy and more quick on the GDP side than in employment. We're not going to see much in the way of inflation. We're not going to see interest rates movement. So you have very low debt rates and interest rates that are supporting valuations. The fundamentals for storage have actually been pretty good, and rents are moving up again for ECRIs in most of the major markets. In the tertiary markets, we continue to see even street rent growth. So overall, if you had to take a look at the entire, kind of sector, you'd be pretty pleased. It's not to say that things aren't going to be bumpy ahead. We do think there's a slog, but it's more of a return to, I would say, normal slog as opposed to sort of COVID-induced pandemonium. And so overall, what I would say is that, you got to take care, either owning or operating, but in terms of the ability to attract capital into the sector and deploy that capital, I would say that the storage sector has emerged quite well. I think some of the trends that we saw and we continue to see in terms of improving efficiency at the site will continue. The acceleration of contactless rentals, which was sort of like talked about in the industry, has become enormously diffused and very quickly, an acceleration of these technology trends. So just like in other areas of the economy, the COVID shock has driven a set of responses that really sort of leverage technology, leverage an acceleration of pre-existing trends. And I think that will probably be necessary. A previous question we had is we will need to see expense reductions, probably most likely in labor, in order to offset real estate tax increases, which are likely to come on a go-forward basis. And kind of with that, I will do what our lawyers tell us to do and show you some copyright notice and disclaimers, and then turn it over to Chris and Megan for some additional questions, if there are any.
Yeah, there are a few. Thanks, Jeff. Do we have any indication of how much new supply is driven by merchant development and who the primary sources of capital for new development are?
Well, in our data service, we do track all of the projects and their developers by name, and we can run reports. I haven't actually looked really closely at the distribution of it, but in general, it is pretty diffused. Of course, there are, I'll call it, the major institutional capital providers, but the development community within self-storage is fairly diffused. The amount of capital one needs to build a site is not nearly as large as that in other asset classes. So you do see a wider dispersion of development organizations. There's also, ready access to debt capital, or there had been anyway, mostly through the commercial banking sector. And while I think that's come in some, it's taken a pause. I think in a year's time it'll probably be back. The institution, there are most of the large, well-established organizations have institutional capital JVs associated with them. So I do think the capital stack is diffused. There is an institutional segment that's large, but I think that part will actually be growing.
Yeah, and Jeff, just
Great,
to add to that, I wouldn't be surprised as storage fundamentals remain strong if you see even more and more of that institutional capital come back.
I know I've spoken to a number of organizations that had made moves to deploy capital in storage. They really were looking for a 5% allocation of their real estate into storage. They didn't have any. They were looking to add to it or to create that allocation. And with COVID, they just kind of put a pause button on it. They just said, I can't think, right? So I suspect that those guys will come back in a year, but that actually, in my mind, they'll have another downturn to look at the data on. And the reason they were going into, and by the way, the sectors they were trying to enter were data storage, data centers, and self-storage. And if you look at the downturn, which ones have done well? Our industrial was already hot. Multifamily was pretty hot. The sectors that have done well in this downturn: data centers, self-storage facilities, industrial, and manufactured housing. And those, three of those four are what's considered fringe institutional asset classes. And I suspect all of those will get increasing allocations from institutional investors over the next 24 to 36 months.
Great, thank you. The next question is, do you think the drops in construction starts could partly be due to counties and the permitting process during the pandemic, or are there other factors?
I think, Chris, and we both kind of talk about this. I mean, the initial shock was both from a perspective of construction delays, construction moratoriums, permitting delays, right? There's a lot of disruption. So everything kind of stopped for a couple months. But it's really a question of, well, what's happening over the last 2 to 3 months? And there, organizations have reformed. Construction sites have started up again. Permitting offices are open in some fashion, either virtually or actually in person to a lesser degree. So business has sort of opened back up to a large degree. And so now I think going forward, it's a better notion of what's happening. The abandonments, in my mind, are the things to watch, because that's a true decision on the part of developers that a project is no longer feasible. And so that's the thing that I'm watching really closely, and we do expect that to increase. Chris, any further thoughts on that?
Yeah, I think you hit the nail on the head, Jeff. I think perhaps on the margins, some of that is still the backlog in permitting offices or zoning offices, but I think, as you said, those entities are back up and running, and really the reduction in starts is on the side of the developer.
Great, thank you both. The next question is, rates are down in lease-up deals due to high supply. Do you think we can get to historical rates stabilized properties are achieving, or will overall rates come down?
Well, if you think about the new projects, and by the way, we have in the handout section the access to the monthly report that was just issued for September with August rates. Lease-ups have so much more new customers, and those rents are going to be under pressure. They're going to be under pressure for an extended period of time. We're seeing a little bit of a bounce back, but off a lower base, right? And so I think if you look at your pro formas, you're going to have more cash cushion to get to stabilization. Once stabilized, right, you can do your ECRIs, and while turnover is 5 or 6% a month, it's a much more sort of stable business. But it's going to take a while for rates to get back to where the current level of in-place rents are, and so that will create some financing need. And if you're running a deal, I think you've got to basically increase your cash cushion to hit stabilization. Stabilization may take a little bit longer and may cost you a little bit more in rents to get there.
Yeah, and the one thing I'd add to that, Jeff, is it really depends on the market and the localized area as well.
Right.
If it's one project that's pushing your rates down, it might be a quick return to normalcy. But I know there are some places that have 4, 5, 6 competitors in a 2-mile radius, and that I think you'll see not only a long slog on the street rates, but you'll see in-place rents have to come down as well to really meet the rapid expansion of the inventory in the area.
Do you think there is an opportunity for a private REIT to refinance properties and lease up to allow for the rents to rise enough to pass on cost to the consumer?
It's a very good question, right? If you think about how low debt costs are, then there should be refinancing opportunities. The real question will be, let's say, will a bank allow you to refi? A lot of the development loans are floating, and so their costs have come down, and it's really a question of what the floor is. But I would think there'd be significant opportunities for an organization that has a significant stabilized portfolio to refi, right, and then use those proceeds, that savings, to basically support their development assets through this. Very good question, and I think there are definitely some financing strategies that organizations will avail themselves of to take advantage of these lower rates. I would say, and public storage may be one of the ones that has a little bit of a problem. They've been mostly financed through preferred equity, which is less risky but more expensive, right? It's an equity piece, but the cost of it is higher than debt.
Great. And then, given the transaction market is quite strong and valuations are holding up well, and interest rates are low and will stay low for the next 3 years, do you think that maybe developers would still want to develop given that high resiliency of the asset class and strong demand?
Well, the question is, if valuations being up would also mean that being able to buy a stabilized property, or the reason people have been building is that the cost of acquisitions have been quite high. And then when you look at that sort of return on capital, you say, well, gee, for a little bit, I can build something brand new as opposed to having to, and you have to accept the lease up risk, but I can get a newer product that's gorgeous, climate controlled, 3 levels, bells and whistles, compared to not much more than what I pay for an older asset. And that's what's been driving the development process. It's cheaper to add new supply. I don't think that fundamentally changes. I think the basic dynamic, right, of why you added supply in the first place and what the valuations were, is basically still intact. So the same, conundrum that people faced before COVID, they're still facing now. The same decision matrix they do. It's just that you've got a bit of trade-off of debt costs having come down to offset mostly any sort of temporary NOI. And if we come out of this relatively soon over the next 6 to 9 months, you could actually see values increasing, right? Because the debts are going to stay low, but the NOI is going to begin to recover. And we see ECRIs, kind of start to pile up. That's how you'll get there. You won't get there so much from new rent increases, but from increases on existing customers.
Okay, thanks. And then one last question that we have. What are your views on industry consolidation? Is the trend continuing, or is private equity flowing into the space, slowing down the REIT?
I view these as complementary. Both will happen both are happening. You're going to see a continuing increase in private equity organizations. They're acting in the same way as a professional REIT would. We're just talking about the ownership structure. Is it public or is it private? But the professionalization of the industry is going to continue, is continuing. The growth of organizations that do third-party property management. There is a significant technology spread between the operations of a professionally managed organization and all of the marketing tools and leasing tools and online contactless tools that are available. That spreads there. Now, I think there is an opportunity with some of the new technology tools coming out to lessen the divergence, but the reason that occurred was continuing to occur. So I think both the consolidation around consumer brands will continue of some sort. Brands do matter, I think, in a storage contest, but there's room for lots of brands as opposed to 5 or 6. There's more than room for that than there. So there's room for a lot of mid-sized organizations to have strong local regional brands. So I think what these are complementary trends. I think you can see consolidation of the industry in general, but it's a very fragmented industry today, and it's got a lot of room to go before it even approaches the level of semi-consolidation that you see in some of the other asset classes. So it's a fragmented industry, and I think it'll be consolidating over an extended period of time, and that even that extension we'll maybe get to 25-30% consolidation among major companies, but that's a long, long way to go from where we are now.
Yeah, and Jeff, just to add to that, I think you and I were talking before the call about how there's still a lot of older generation facilities, even in kind of mid-metro areas, where I could see a larger institutional player coming in, buying a small facility and then expanding it, or buying it and then rehabbing it with the tech trends that you were talking about. So yeah, I think there's a lot of the industry still out there owned by non-institutional players. So that trend of consolidation is only likely to keep going on.
And the truth be told, I mean, there is room if the exit strategy for a private equity organization was a new IPO, there's room in the public markets for additional storage IPOs. There's only 5 or 6 that are actually publicly traded. So it depends upon what's the valuation of the exit. Is an IPO a better execution strategy than either a hold or a sell to one of the existing public REITs? So I think there's an appetite. There's going to be a continued appetite for storage, self-storage organizations, whether both public and private hands.
Great, thank you. That is it for the questions.
Well, thank you all very much for your time. It's been great to get to spend some time with you. And then Megan, if you could wrap us up.
Absolutely. Thanks, Jeff. And thank you everyone for participating in our program today. We hope you enjoyed it and found the information and viewpoints helpful. If you would like to subscribe to any of our free research, please either log on to yardimatrix.com or contact us and we will add you to our distribution. A recording of this broadcast and accompanying slides will be available after the program. A special thanks to Jeff Adler and Chris Nebenthal for their commentary today, and I would also like to thank Jeff Muth and Mary Chu for running the web program and Claire Anhalt for her contributions to the content. This has been a production of the Matrix Division of Yardi Systems, Inc., copyright 2020, all rights reserved. This concludes our broadcast. Thank you.